Hello, I'm Bernard Hickey from interest.co.nz and welcome to another in our series of videos aimed at small to medium business. And today I'm here at Kiwibank in Wellington with Nigel Gaudin, who is the Head of Financial Markets at Kiwibank. Nigel, g'day, how's it going?
Good, thanks Bernard.
Good. Hey, I'm just trying to work out, if I'm a small to medium business and I'm thinking about importing something or exporting something, when should I start to think about those foreign exchange risks or the things that matter?
So Bernard, it's very much a materiality thing for you as an individual, and people have different risk profiles that they are prepared to take on themselves. But to be fair, unless you're dealing with funds of over $100,000 a year, the currency effect probably isn't going to have that much impact on the New Zealand dollar portion of what you're going to pay away. Having said that, it does depend a little bit on the timelines that you're actually dealing with, because if you're not looking to import something for over 12 months, then actually the currency effect on that could be quite large. And if you look at how the currency has certainly in the last 12 months moved, then against the US dollar you could easily be paying anywhere between 75 cents and 86 cents. Wow. So a 10-cent move is actually quite material.
And particularly if you're importing something over a long period, let's say you order the stuff and it doesn't arrive for 6 months,
yes,
that could make a real difference, couldn't it?
Yeah, absolutely. And so, an individual's business cash flows, their risk profile, their risk appetite themselves, all that needs to be taken into account when they're looking at their own business and whether or not they should be looking to hedge themselves against those currency movements.
So hedging, how does that work if I'm a small to medium business?
So I guess the things to start thinking about in their own business is, what is my cash flow cycle? Even before they've thought about how they might go about managing their risk, what's my cash flow cycle? When does my actual currency exposure begin? So it really does start looking at your end-to-end cash flow cycle. Then it's a matter of going, well, in my business, how risk averse am I? Do I want to cover the exchange rate risk, or actually is it not that material to me at the end of the day? Once you've worked that out, then it's a matter of saying to yourself, where is my break even on this import or export for that matter? So how much does it cost me to produce it? Where does my break even rate come in? Where do I actually, if the currency moves to a certain level, where do I actually start losing money? So you've got to do all that sort of stuff before you then start thinking about, okay, what's out there, how can I manage that risk? And it may well be that actually doing nothing for your business is quite right. But for a lot of people that's not, and they choose to manage the risk on an ongoing basis if they have that regular import or export flow.
So if I'm talking with yourself and I've decided, yep, I know what my costs are and when they're going to happen, and I can work out when it's profitable or not profitable, how do I do something so that I can hedge that risk?
Right. So once you've figured out all those sort of things, then it's a matter of getting in touch with probably your bank, and certainly we get alongside a lot of our customers to assist them, both with understanding where their business sits, but also helping them manage their exchange rate risk. So getting in touch with either through your business manager, with an expert inside the bank, who can assist with the ongoing nature of what you're trying to achieve. And so we would sit down with a client and look at what their timeframes are. Do they just want to use a spot forward exchange contract? Do they want to take a forward exchange contract? And both of these are very good ways of managing risk. Do they want to buy the currency outright and put it in a foreign currency account? So there's any number of ways. There's foreign exchange options, but like an insurance policy. And then you can get into more complex nature where you might take a foreign exchange loan, foreign currency overdraft. Quite a number of ways that you can actually manage that ongoing risk.
Horses for courses.
Horses for courses, absolutely.
Yeah. And the cost of it, I mean, how would you measure the cost of it?
So there's no real upfront fees for forward exchange contracts. There will be, as part of your facilities with the bank, you may need to provide some form of collateral to cover yourself, especially if you're looking to take a forward exchange contract. And having said that, something like an option, where it's a bit like an insurance policy, then yes, there's an upfront cost to buying a forward exchange option. but then you're not obligated to take the contract at the end. So, as I say, horses for courses, and best to approach your bank as to actually the cost of doing some of these things.
Now, for a lot of people, when they're thinking about exchange rate risk, they're thinking, is the currency going to go up or go down? And
Yes.
it's a pretty tough one to pick.
Yeah.
So how should small to medium business think about this? Do they come to the bank and say, well, I know for sure that currency is going to go up or it's going to go down? I mean, what do you say to people like that?
Yeah, so there's two ways of looking at this. What we would suggest to customers is go through their cash flow cycle, work out where their costing levels are, figure out what their risk appetite is, and then actually take their thought process around whether they think the currency is going to go up, down or sideways completely off the table, and purely look to hedge for their business. At the end of the day, they are in business to either import or export something, by covering the exchange rate risk, then they can guarantee they're going to hit the margins they expect to, and therefore the profit should fall out of the business accordingly. To do it any other way is purely speculation. If you want to speculate on the currency, that's fine for you, but call it for what it is, and probably keep that separate from your business. Because at the end of the day, as we've seen in the last 2 or 3 years, the currency is very volatile. And with what's going on in the US with their money printing and quantitative easing that they're bringing in, you've got currency controls in China, you've got all the fallout in Europe. It's not easy to forecast where the New Zealand dollar is going to go against purely the New Zealand US rate, let alone against the euro, the pound, the yen, whichever.
Excellent. Thank you very much. Nigel Gaudin there from Kiwibank. He's the head of financial markets. I'm Bernard Hickey from interest.co.nz. That was another in our series of videos for our business section, brought to you in association with Kiwibank and Deloitte.